Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And today we're going to be going back to a style of chart that we haven't used in this webcast series for months. It's known as a Heikin Ashi candlestick chart, and it's sometimes used by traders when they can't quite see through all the clutter of the day-to-day traditional candles, red candles, white candles, red candles, white candles. This is a style of chart that's sometimes used to just smooth out that day-to-day activity and hopefully provide a clearer picture of what price has been doing recently. We're going to be talking about the pros and the cons of this sort of an approach, and we're going to be using Heikin Ashi candles to build a short-term stock trading system. Should be a really interesting discussion. We're going to be combining it with another technical indicator. A lot to cover. Before we can get to any of that, though, let me first of all say hello to everybody that's already chatting in. Hello there, Jay Richardson and Jim, Lori, Eric, Dwayne, Scott, Paul, Marie, Pinshape, Jack, Dave, everybody else. Thanks for joining us week after week. We really do appreciate your attendance, your contributions to these discussions. I have to acknowledge, thank you for those that have said happy birthday. Appreciate that. Yep, 53 years ago today. But guys, if you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, we'll enjoy the presentation, but be aware that you're invited to join us in this live discussion. This is a Friday webcast series, and we kick things off promptly 1 Eastern time. If you'd want to join us here in our live stream audience, we'd love to have you here as an audience member. And as a nice little treat for our live audience members, I have my very good friend Mike Fairborn is going to be hanging out in the chats, answering any questions that I can't get to. Mike and I have been working together for years and years and years. So Mike brings a lot of knowledge and experience to this discussion. Thanks for having my back there, Mike. Now, Mike and I would also like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite presenters there. That's the best place to connect with us in between these webcasts. As a matter of fact, I was just on X literally like 10 minutes ago, just responding back to some replies to a couple of my posts. So that is the best place to connect with us. You can find Mike there at Mike Fairborn CS. You can find me there at Cameron May CS. But let's get into this discussion of Heikin Ashi candlesticks. Now, I know it's been months since I've talked about it here in this webcast series, but I want to throw out this question. 22 people watching right now. Tell me, are you familiar with Heikin Ashi candles? Yes or no? But let's go into, first of all, the important considerations regarding the risks associated with trading and investing. These disclosures are important. Bear them in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. And investing involves risks, including the loss of principal. Okay, so I'm already getting some chats in. Dwayne, JD, Jack, no, Kevin, no, Chris, Jay Richardson, Life in the Fast Lane, Dave, say yes, and Cornelius is somewhere in the middle, somewhat familiar. Well, all right, let's get acquainted with what these things known as Heikin Ashi candles, what they really are. And then we're going to combine those with another technical indicator into an example, a short-term trade system. So here's what we're going to be doing today. First, we're going to take a look at our existing positions in our paper money portfolio and a quick peek at market conditions through our trend value momentum lens. Then we're going to get to the discussion of Heikin Ashi candles. How are they built? How might they be combined with other technical indicators into a short-term trade strategy? Then we're going to place a trade using that approach. Of course, we're going to be looking at examples along the way. So let's go right to Thinkorswim Desktop. Now, if you're not familiar with this platform, this is software that can be downloaded from within your Schwab Online account. You just go to the Trade tab and then look for the keyword Thinkorswim in the drop-down menu. Click on that, go through the on-screen prompts, and it'll help you download the software. Doesn't cost anything to download that software. But here we are. We have 3 current positions, or at least we started the day with 3 in our advanced charting portfolio. We actually no longer have our AT&T shares. As I was preparing for this webcast, I actually saw the trade execution on AT&T. We just got stopped out of that position. Let's see what that means. Okay, but first of all, we have Amgen, we have 20 shares. Shares are doing okay. Not having the best of days right now, though. So here's what's going on with that. Our original Amgen trade was placed back here. A combination of two moving averages were used to place this trade. Two triangular moving averages, a 20 period and a 5 period, and really a crossover of the 5, that's the shorter or the faster moving average, crossover above the 20 or the slower moving average. That was our signal. So we actually took our trade back here with a plan to sell if we got what's called a bearish crossover, the 5 dropping back down through the 20. We had that, but at that time, we weren't having a webcast. So it happened while we were not convened. We couldn't take action on that. And then I went on vacation and the stock kept coming down. So really this should have been just a quick in and out trade. Likely would have made a small profit there. But since then, we've just been keeping an eye on it. It seems like every Friday when we go back to look at this Amgen trade, the 5 is trading above the 20. And I wanted to talk about selling when it's finally dropped below the 20. Now, if you didn't see this discussion, and as we go through our other symbols, you're going to see other technical indicators that might not be familiar to you. These trades were taken on camera. The logic of the trades was described on camera, and the place to find that is on our YouTube channel. So if you haven't done this already, go down and click on the subscribe button. That'll subscribe you to our YouTube channel. It doesn't cost anything. Literally only takes a second. But our Trader Talks Schwab Coaching webcasts is where we house our playlist for previous webcasts, including the discussions where we set up all these current trades. So if I go to playlists and I scroll down, we got a bunch of different webcast series. Mine, you'll find, just scroll down about halfway. There it is, Advanced Charting Techniques. You can go to View Full Playlist. And here are those previous trades. TTM squeeze discussion, advanced decline line, plus the McClellan oscillator, trading strategy. You can find all of those previous webcasts right there. All right, so let's go back here. I wanted to zoom in on what's been happening just most recently. Now, unlike so many trades that we've taken, this one was actually done on an hourly chart. Chris says, it looks like we can finally exit with a small profit on that one. Yep, it might be that time, Chris. As we look at what's been happening over just the last few trading hours on Amgen, the 5 hours of trading on this exponential moving this exponential moving average, it crossed down over the 20 triangular moving average. There's our signal to exit. Let's go exit. Let's go here. As a matter of fact, it would have been nice had we seen this, maybe a couple of hours ago, but we weren't talking then. So let's go back to our monitor tab. And I'm just going to right click on that. Pardon me, throat's struggling a little bit. Create a closing order and let's sell. Now we could submit this as a limit order. In the interest of trying to get a quicker fill, I'm going to switch that to a market order. Of course, when we choose a market order, there's definitely a risk we might not be thrilled with the price we receive. Right now it's trading at $295.35. It's not a guarantee that we will get that price. But if we get it $295, and change, we entered this trade, as Chris already pointed out, a little bit lower, $286 and change. Let's see how we do. Click confirm and send. Going to sell those 20 shares of Amgen at the market price. With market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. And let's send that off. So that should get an execution here pretty soon. Well, let's move on, though, with our MAR trade. This was our trade that we took not last week. Last week was a holiday. Oh, yeah, looks like we're out at $295.49. Okay. Realized gain there. With Marriott, let's go have a look at our chart. I'm going to have to switch things up a little bit. This was not taken on an hourly basis, but on a daily basis. So let's switch this to a 1-year chart. And it was from a different combination of technical studies. So I'm going to go up here to our studies, and we saved that as a study set. It was our Arun oscillator and the 1050 exponential moving average trend confirmation. So if you weren't here for that discussion, what we noted here on our Arun oscillator is that we had just gotten a bullish crossover of that zero or that signal line. And our 10 exponential moving average was above our 50 exponential moving average. To some, that might confirm the trend was bullish. And then this may be an indication that there is some momentum in that trend, some new bullish momentum. So we took our trade here, and that's been working. It's been going higher with a plan now. If we get a bearish crossover like this event here, or this event here, or this one back there, that will be our exit. So I actually wrote a text note on here just to remind us what we're looking for. That one looks fine. We're going to let it continue to work. So then we had our AT&T position. Show you what's going on with AT&T. Notice we have 0 shares at this point. Earlier today, I had my eye on this. Let's switch this to our AT&T study set. This was the parabolic stop and reverse and the 100 simple moving average. And unfortunately, we weren't having a webcast. We didn't have a webcast last week. We didn't get a chance to manage the risk on this trade. I only do adjustments to this portfolio while on camera so that we can understand the logic of what we're doing, and we can essentially record it for posterity for at least as long as it stays on YouTube. But with our parabolic stop and reverse, a pre-qualifier is that we have an upward sloping 100 period simple moving average, and we have that. The trade criteria was that we're trading above our PSAR dots, basically. Again, if you want to see the logic of this, if you want to see where the dots come from, what they mean, you can go back and look at the archives where I described where you can find those. In any case, the plan here was to move our stop up 1% below each dot. Now, we didn't meet last week, so we didn't get a chance to move it up. That would have been about right here. We would have been 1% below about that level. So yesterday is where we should have stopped out. Unfortunately, our stop was from a previous dot. It was from a couple of weeks ago. So we fell a little bit lower and got stopped out today. Now, what did that do? Well, what it wound up doing is it caused us to surrender about $80, $90 more in gains than we otherwise might have had. But overall, we exited that trade with a $106 profit total across 200 shares. Just a small profit, but we'll take it. That one's done. All right, now there's one other trade that we need to talk about that since we met last time, 14 days ago, we got booted from this trade. Good Koopa says, how do you have different studies on charts for each of these stocks? Is that done by loading different study sets? It is, yeah. So when we, and I'll do this maybe a little bit later today, but when we add a study to a chart, we can go up here where it says studies and just save that study set. And then it just puts it in this menu. And then we can just, as we move from one symbol to the next, I like to put the symbol in there and then the technical reason, the technical logic, so I can understand it. But those names, you can give it whatever name you want. All right, anyway, we had a position in Bank of America. That position is done. Here was the logic of that trade. Let's go up to our studies. Let's load up our Bank of America TTM squeeze. What we saw here was we had a series of red dots, a TTM squeeze indicator. When we start to get red dots, what that means is that the stock is actually really calming down, not trading in a very wide range at all. And you'll notice right before this series of red dots, the stock was starting to go sideways. And then the signal for our TTM squeeze trader is when we get a green dot, meaning the stock may be on the move again. We get a green dot accompanied by a blue histogram bar, because if it's a green dot accompanied by a red histogram bar, that might be signaling the stock is about to go down. Here, green dot, blue histogram bar, maybe that stock is set to rise. It's coming out of a quiet period. It might be ready for an explosive move. So we took an entry right here. And to plan where to exit, we just looked at leading up to that entry, where was resistance, where was support, what was the channel that captured that period of lower volatility. And then we just duplicated that channel. We were trading between about 42 and a quarter up to about 45 and a quarter. There's about a $3 channel here. So an expectation from here, if we break out at about 45 and a half-ish, maybe we'll go up about another $3. We actually had a target up there at 48.60. Done. Trades accomplished. We hit our target, and looks like right at a good time too, selling off. So that trade is concluded. If you want to see that, if you ever want to see historical account information, you can go to your account statement, set the number of days back, like let's say over the last 14 days. Actually, let's go a little bit further back just to make sure that we capture that entry, not just the exit. And then gear it just toward the symbol that you're interested in. So here was our trade. Bought 100 shares at 45.42, sold 100 shares at 48.60 at our limit price. So that trade's done. That leaves us with these two. But let's plan and place a new trade. And we're going to use our Heikin Ashi candlesticks to do that. But the first thing that we're going to do before we do that is get some market context. So let's switch things here to the S&P 500. Let's switch up to the typical study set that we use. And this is just an example study set. It's not, I don't want anybody to have the impression that this is the study set for analyzing the S&P 500, but I call it the Trend Value Momentum Study Set. That's my name. That's the name that I've given it. It's for a system that some traders will use to trade individual stocks, but also to assess technical market conditions. And it's a combination of a couple of moving averages for trend, an oscillator or an indication of potential short-term value or maybe overvalue, and an oscillator for potential indication of bullish or bearish momentum, TVM, trend value momentum. So what's the trend? I don't know. Is anybody surprised if I say the trend looks bullish? Our 50-period triangular moving average is above the 100-period triangular moving average. The faster moving average, faster trend line appears to be rising more rapidly than the slower trend line. So that might put a check in the box for bullishness. But let me get your thoughts on this. Has anybody been asking themselves, maybe like somebody in my webcast yesterday said, feels like things might be getting pretty high? I think that could be a concern of a number of traders. Now, markets could just continue going higher, but let's see what our value and momentum oscillators have to say. First of all, our RSI may be used by some traders to identify when stocks or indices have potentially achieved short-term periods of being underpriced or short-term periods being overpriced. And when we get RSI above 70 on the S&P 500, that may be an indication to some that, yeah, things have gotten a little bit lofty and maybe they'll come down for a bit. It's not necessarily time to hit the panic button, but for users of the RSI, when looking at the S&P 500 through that lens, it might just give them pause. So as examples here, you'll notice, what have we had, like 2 other times this year or in the last 12 months? RSI poked its nose above 70 right there. And if you look at what that coincided with, stocks kind of had a little bit of a rough patch there for a while. Didn't really get a chance to go much higher. Actually, for like 7 months after that, we went down, kind of struggled along sideways, and then significantly down. Now, before that, there was one other time where we reached a peak above 70 and slipped back down below, and that was about right here. So you can kind of see the logic of why a trader might just say, well, things have been bullish, but maybe they've been a little bit too bullish. Okay, there are likely to be some who might be looking at this and saying, maybe I'm going to ease off the throttle a little bit on new bullish positions today. But overall, maybe that might be projecting a turn down to support if we go down. No indicator is perfect at spotting reversals. So it's not a guarantee that the prices are headed down from here. But if they do, the question might become, well, how far? And maybe down to the previous highs. All right, now finally, we have our momentum oscillator, which when it rises high, that's very bullish. But if it starts to shift downward, that may be a signal that an upward move is losing steam. It's not perfect. You can see here, it looked like it might be losing steam, and it was very temporary. Here, on the other hand, looked like it might be losing steam, and it was significant from there. And it was also significant from back here. Here, it kind of did a nice job of spotting what turned out to be all-time highs for a little while. So what's going on with potential momentum right now? Well, we've hit a short-term peak, starting to soften a little bit. That, in combination with our value indicator, might again cause the trader to hesitate. Even if they're bullish, they might think, well, maybe I'll just wait to see if we can just come down maybe to trend lines or to a support level, to a previous price ceiling that might act as a new floor. Lots of different ways that we might anticipate where that next level may be. But here's the deal. That would be kind of boring if I just dismissed this discussion right now and said, well, that's it, guys. We can't do anything from here. You might say, well, Cameron, why don't we just do something bearish? Markets are a fraction of a percentage point below all-time highs. If a trader is, let's say they'd like they prefer to trade on the side of existing market trends, that's trading in just about as bullish a market as we could ask for. Trading bearishly, that might be tough. Maybe it's a good idea. Time will tell. But I'm going to go ahead and plan and place a new bullish trade. Just be aware that this is sort of a technical backdrop. Scott says, why do you use MACD histogram versus just the MACD? Could use the MACD, like the MACD 2 line, Scott. This is just a different visual expression of the same data. I could design trade systems using either one of those that are going to generate essentially identical outcomes. Ricebird says, what would show the signal bearish divergence? So Ricebird, that would be if price is going one direction, but one of our oscillators, more typically the RSI than the MACD, bearish divergences are just really super common on the MACD to the point that some traders just don't give them any credence. For example, here was a divergence here where price highs are going higher, but the MACD is going lower, and really the price just kept going. So more typically it would be if the highs, but if price is going one direction, but an oscillator is going the other direction like the RSI, that would be a divergence, and I don't see that right now. So I'm going to hit the pause button before we get to our Heikin Ashi candles and plan and place that trade using in combination with another technical indicator, because there is a survey that's been added to the chat window today. So if you get this opportunity, please take advantage of it. We don't always get the chance to give the presenters feedback via this very short survey. It's really just 2 multiple choice questions, and then a comments box and a suggestion box if you want to add some additional flavor to the feedback that you're providing. But what I will say is if you take the time to fill out that survey, I'll take the time to read through that. That is a key for helping me improve my webcast. So thank you for doing that for me. If you would go ahead, click that survey link and then fill it out at the end of the webcast when you give me some honest feedback. All right, so let's plan and place our example trade. So I need to clean things up here. Let's come up to our studies, and I'm just going to remove all these studies. It doesn't mean, this is not like deleting the study set. This is just getting them off the chart for now. And I want to go back to a stock that we talked about for a different technical approach just yesterday. I think there's an important lesson that can be taken from doing that. And that is different technicians can use different approaches to maybe even trading the same security. So let's bring up AMD. Here's AMD. And right now we're looking at this using traditional candles. So I'm not going to go deeply into what traditional candles are. Almost everybody watching would know exactly what they are. But here's one of the faults that some traders find in traditional candles, and that is they change their minds so rapidly. If a trader is just trying to make shorter term, even intermediate or longer term trade decisions, but they're looking from one candle day to the next, one candle to the next, white one day, or I should just say white on one candle, red the next candle, white one candle, red the next candle, it can get confusing about which way is price actually trying to move. Do I pay attention to this new red candle, or do I wait for tomorrow's white candle? What do I do? Also, what you'll notice on advanced micro devices, and this one kind of stands out more than most stocks, is that there are lots of overnight gaps. Gaps up, gaps down, gap with the trend, gap against the trend. Ramesh is looking at a double top pattern. I don't see one yet, Ramesh. Maybe you're looking back here. If you're looking at these two things right here, this may just be a high and price is moving past that. Time will tell. We'd need a little bit more data, a couple more days of trading before we could say with a little bit more confidence which we were seeing. But in any case, those inherent, what some would label faults of traditional candles, are exactly the motivation for why some traders use what's called a Heikin Ashi candle. So I'm going to throw those on our chart, and you're going to see they are very different. So the way that we add those, we come up and we change the style of chart. Our current chart type is just a candle chart. Well, I'm going to choose Heikin Ashi. Look at that. So what you should immediately see, let's do a quick remembering what we now know about AMD's candles. Number one is there are no gaps. Heikin Ashi candles are specifically constructed to eliminate gaps. It builds in overnight information to sort of smooth out the view of what's going on from day to day or from candle to candle. Now, another thing that you'll notice is that once we get a series of white candles going, they tend to stay white until there's a relatively significant reversal. Once we get a series of red candles going, they tend to stay red. Now, there are exceptions to that, but they're relatively less common. So, for example, there's a long stretch of white candles right here on AMD. There are a couple of reds right there and right there. But overall, for some traders, they may see this as a smoother presentation of candles, maybe a little bit easier to read. Now, easier doesn't mean that it's going to be superior in every respect. That's not the case. But these are Heikin Ashi candles. So how are they constructed? Well, they have an open, high, a low, and a close, just like traditional candles. So I'm just going to quickly revisit. Here's what I'm going to propose to you. If you want to see me explain this in greater detail, what you can do is go to my, I'll go right to the start again. If you go to the channel, Trader Talks Schwab Coaching Webcasts, go to the playlists. Oh no, I'm going to do it an easier way than that. I just changed my mind. Go to our channel and just look for it. Just do a search for Heikin Ashi. I think it's easier to spell Ashi than to spell Heikin. So it's A-S-H-I. And there you'll see our last time we used this type of candle was back in like late winter. Anyway, we're in July 11th. It's July 11th right now. Anyway, trading stocks with Heikin Ashi candles versus traditional candlesticks. I went deeply into how these are built. So I'm not going to type it all out like I typically do. Instead, I'll just explain. These are constructed open, high, low, and close. So let's just start with open. The open of every Heikin Ashi candle just starts at the middle of the body of the previous candle. The end. That one's pretty easy. So you'll notice today's open, so the open on a white candle is here. The open on a red candle is at the top of the body. Open on a white candle is at the bottom of the body. But you'll see that's right in the middle of yesterday's body. The open of yesterday's candle was right in the middle of Wednesday's body. So that's the open. The close is just, the close actually goes back to the traditional candles. So, again, if you want to see this on the archives, I wrote this out so you can follow it. But it just looks at yesterday's normal candle, it takes its open, high, low, and close and gets an average. That's it. So that's how the closing value is determined. So if we were to look at the candle from yesterday, this candle body close is just the average of all the trading from yesterday. Now, the high for a Heikin Ashi candle is it's the higher of two things. It's either the open. If you look at this candle right here, you'll notice that that open is also the high of the candle, because we look at the high of the candle, of the Heikin Ashi candle, and we look to see if trading during the traditional trading hours went any higher than that. In other words, did we go any higher than yesterday's midpoint? That's a different way to put it. That becomes the high, and then just the inverse of that becomes the low of a candle. The low is established by, well, did today's trading go any lower than yesterday's midpoint? That's how these are calculated. Isaiah says they're a study that calculates Heikin Ashi candle open, high, lows, and close to give direction of trend like a moving average. There can be, Isaiah. I'm not going to be doing that today, but that should describe for you open, high, low, close. I took way more time to explain it last time, but the net here is a smoothing of the day-to-day activity, and some traders find value in that. Now, there's a typical interpretation of these candles. There are really 5 types of Heikin Ashi candles. Let's talk about those types for just a moment. The first one is a bullish candle. A bullish candle, good example, is this one right here. It's a white candle where the close was higher than the open, but there's also a little bit of a tail sticking out of the bottom, meaning at some point trading got a little bit lower than yesterday's midpoint. That's how that would be determined. Still bullish. Prices are going higher. That's a bullish candle. Then we have a strong bullish candle. Notice here, this candle, this candle, this candle, there is no wick sticking down. The story that tells me is that at no point of trading did price get lower than the midpoint of yesterday's body. So that's just shown on the chart as a candle with no lower wick. And that's seen as being particularly sharply bullish, a strong bullish candle. Now, a third type of candle doesn't rely on the color of the candle. Instead, it's the shape of the candle. What does this look like if we're talking about traditional candlestick patterns? What does that look like when we have a small body with a long wick sticking out the top, a long wick sticking out the bottom? It looks kind of balanced, almost like you could grab it on the top and give it a spin. That is a spinning top candlestick. When we get small bodies with wicks sticking out the top and the bottom, that's sometimes seen as a potential reversal candle. So we have bullish, we have strong bullish, reversal, and then we have bearish and strong bearish. So let's find an example of a bearish candle. There's one right there. A bearish candle right there when we have a red candle with a little wick sticking out the top, meaning that prices only got a little bit higher during the day than the midpoint of the previous day's candle. And we closed lower. So that's bearish. This one is strongly bearish. That's where we have no candle out the top, or no wick out the top of that candle. So we have bullish, strong bullish, reversal candles, bearish and strong bearish. And those reversal candles can happen at the bottom of down moves as well as the top of up moves. So here's a couple of examples right here. Here we have a bullish candle followed by a whole series of strong bullish and bullish. And then we get a reversal candle right here, signaling, our traders of Heikin Ashi candles are probably projecting somewhat of a move to the downside. We get 2 strong bearish candles, and then what is this? Small body, wick, shadow. That's a potential reversal. It didn't actually pan out. We got another strong bearish, And then what do we have right here? Small body, wick, shadow. That would look like a possible reversal pattern and a confirmation of a bullish candle or a strong bullish candle after that, maybe a signal that we're starting to move up again. So those are your 5 types of Heikin Ashi candles. And for some traders, they might just trade those all by themselves. Now, they might look at this and say, well, here was a down move. There's a reversal candle. There's a strong or a bullish or a strong bullish candle. And I'm bullish until we get a reversal candle followed by a bearish, and so on. But for others, they may prefer to have a trend confirmation as well. And this is where we're going to introduce another technical indicator. And this one's probably going to be familiar to most of you. We're going to be using an exponential moving average. And quite commonly when trading these candles, you'll notice the signals, like from one reversal to another, they tend to not be very long term. So if we're using another technical indicator, the trader will commonly use something that's pretty sensitive, pretty short term in spotting or helping to identify potential reversals as well. So I'm going to go up here and let's add an exponential moving average, and I'm going to stick right with the Thinkorswim default. This happens to be one of the most commonly used moving averages that are used in combination with a Heikin Ashi candlestick chart to design like a short-term trading system. So let's click apply and click OK. And I say happens to be one of the most common. It's the one that I've probably encountered most commonly in my own experience. It's always tough to provide, it's not like I took a poll of 1 million traders and 642,000 of them said this is the way they do it. I'll have to qualify that by saying it's been my experience. Right? Quentin, it's a good question. You're going off on a different tangent. Unfortunately, I don't go off topic in these webcast series. It tends to muddy the learning experience. So you've asked a good question. It would be outside the scope of this discussion for me to address it. Okay. Anyway, but maybe since it's options related, maybe pose that in an options webcast series. Okay. But here we're looking at a 9-period exponential moving average. We're using between a triangular, and an exponential moving average. This one tends to be the most sensitive to recent price activity, generating faster entry and exit signals for better or for worse. Faster doesn't always translate to better. But what some traders will do is they'll use this in combination with their understanding of Heikin Ashi candles. And specifically when they see Heikin Ashi slip down below our exponential moving average, our short-term moving average, and then close back up above, that may be the entry signal. So this is interesting because here we got a close above our exponential moving average very recently, but through the traditional Heikin Ashi lens, that's not an entry signal. If we were just trading Heikin Ashis, this is a potential reversal. This is a reversal candle. But for someone using a Heikin Ashi price crossover system, that could be a perfectly valid entry. So this was a recent signal on advanced micro devices. We weren't there to see it because we weren't having a discussion back there on Tuesday. Prices started to move. We're at 146 now. That looks like that happened more like a few dollars below where we are right now. I think we're going to take this as our example trade anyway. So if that's the entry, 2 other things that the trader might want to consider. Well, where might we take profits and where might we take losses? Well, a typical exit signal is when we get a bearish crossover where we see the Heikin Ashi candle closing below that 9-period exponential moving average. So there would be an example of that right here. This would be an example of that right there. Now, sometimes what that means, the trader gets out. Possible they might get right back in to the same stock. But let's make that our plan for taking profits. We don't know where that might happen. It may be weeks from now. It may be days from now. We'll just have to keep an eye on that in future Friday webcasts. What about the other side of the equation? Well, here, if the trader's logic for getting into the trade was because it looked like we were behaving bullishly, if the stock starts to fall again, if they do want to place a stop, an automated stop, without watching just for the crossover, we could set like an alert to get us out if we slip back down below that exponential moving average. Or the trader can also place an initial stop down below the recent low. Chris says, can we use maybe another technique, use a flagpole target? We could, but we're not talking about flag trading here today. Good question there, Chris. Flag is actually what we did on this trade, yesterday or the day before when we were having that discussion. But I'm going to place our example exit just below this recent low. That low is going to be 133.50. Let's give it a couple bucks down below that. Could be a couple of percentage points, $1 or $2, a percentage point or two. Let's say 130, 131.5. That's going to be our plan. Let's go place our trade. Let's go to our trade tab. And I'm going to right click on the ask price and put in a custom buy order with a stop. We're not going to include the targets. We don't know what that's going to be. When the price falls or the candle closes back below our 9-period exponential moving average, we can only see that when it shows up, right? So let's see. 10 shares would be about a $1,400 trade. How about we do, let's link these together. Let's do 20 shares, about a $2,500 trade. I'm going to submit this buy order as a market order. Now, we know there's a risk when placing market orders. We might not like the price that we receive. We're not guaranteed that we're going to fill for exactly what the price is at the moment. And our stop, let's put that down there at 131.50. Got a good till canceled order. So we have a mechanical exit for managing the risk on this trade, but there's going to be some manual oversight. Be looking for the target exit or the profit taking exit if it should happen to be profitable. So let's click confirm and send. Going to buy 20 shares of AMD at the market price. Going to sell those at a stop of 131.50. With stop orders, there's no guarantee the execution price will be equal to or near the activation price. So could be well below 131.50 where we sell. With market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from quotes displayed at order entry. Let's send that order off. RC says your chart showing the HA price or the actual price? That is the actual price. Yeah, the Heikin Ashi candlestick construction is a little bit different, but price quotes are the same. Chris says, I guess my question was really, are the flag patterns in Heikin Ashi candles just as valid as standard candles? Well, the logic still applies. Validity is going to change from one trade to the next, right? What the trader would ultimately say is, well, on my trade on stock A versus stock B, A was a traditional and B was a Heikin Ashi, and one of them made money and the other one didn't, and therefore one was more valid than the other. Now, the concept is the same. Validity, that time only tells from one trade to the next. All right. But guys, we've accomplished what we set out to do today. I wanted to go through our existing positions, but spend some good time talking through building a short-term trade system. This is an example trade system. Lots of other ways we might have built it, but using the Heikin Ashi candlestick chart. I hope you enjoyed that. I always like talking about these different technical concepts. Lots of tools available. We're going to talk about more of those next Friday, so I hope you'll put it in the calendar to join me then. But just make sure, as I turn you loose to go enjoy the rest of our webcasts and the rest of your week, First of all, make sure that you have subscribed to our Trader Talks channel. This is where you can find our playlists. You can do keyword searches for items of interest. And you can join our live streams right there. You can subscribe just by clicking on the subscribe button down in the lower right-hand corner of your window right now. It doesn't cost anything. And literally only takes a second to accomplish that. Also, make sure that you're following Mike and me on X. You can find Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS, but this is where I can post things and have interactions with you in between the live streams. Like here's a video that I posted yesterday about how to link different tools on Thinkorswim so the symbol follows you around. You don't have to type it in every time. Now, everybody, this is also going to be my quick final reminder to fill out that survey if you would. There's a survey that's been added to the chat. Click on that survey link. Your honest feedback is always appreciated, and I will read that data and I read those comments, so that's definitely appreciated. And a final thing that I definitely appreciate is out of nearly 200 people watching, 73 thumbs up already. That's awesome. Thank you. That sounds like applause to me. Gives my webcast a boost in the YouTube algorithm. If you enjoy one of our webcasts, just make a habit of clicking that like button. All right, everybody, go have a great weekend. I'll see you next week. I'll look for you in future webcasts. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.